Good morning. I'm Gord Long with the Financial Repression Authority. As part of our series on risk mitigation, I have Professor Amin Rajan joining us this morning from the UK. Amin has been on before with us. He's a professor and a chief executive officer of Create Research. Welcome back, Amin.
Thank you, Gord.
Do you still do some teaching at all, or is it full time with Create Research?
Well, I do some part-time teaching, mainly run executive education programs for senior executives.
Could you? We have so many new listeners, viewers joining us. Could you just give our viewers a brief overview of your background, things you're involved with?
Okay. I started my working life as an economic forecaster in the UK Treasury, where I was for about 8 years or so. And from then on, I was seconded to University of Sussex, which is on the south coast of England. And I was a program director for research on major programs about the future of organization, work, and society. And from then on, I went on to find Create about 25 years ago. Create Research is a specialist boutique which very much focuses on investment matters around the world. In particular, we look at macro drivers of investment behaviors. We look at macro drivers of asset allocation, and then we talk about their impacts and so on. And every year we do two major surveys. One which covers all investors like pension plans, insurance companies, wealth managers, and so on. And the second survey that we do very much focuses on pension plans because their needs and their problems are really quite unique. So we like to give a much greater focus to that particular group. And it's in the context of that we published a report about the impact of financial repression on pension plans, which you very kindly covered for us last time around.
Well, we actually, that's what we're going to continue to talk about here this morning. I mean, as you know, the last time we talked about some of the investment themes of what the pensions, all the 100, I guess it was 184 thereabouts, European pension plans that you surveyed and what they found. But today I was hoping that we really focus on on actually chapter 3 of that report, and I have the index up here on the screen now of how they're coping with financial repression, not just investment from a structural standpoint, and to talk about risk, structured approach, and this whole personalization that's going on. Maybe we could just kick it off and talk about risk.
Yeah. Okay. There is a huge emphasis on managing risk. In fact, the old emphasis on maximizing returns has shifted from maximizing returns to minimizing risks. And in that context, there are two broad principles which are being implemented. The first principle is that the sources of risk in future are going to be very different from sources of risk in the past. In that, in the past, it was the debt crisis which sparked risk. Now there are quite a lot of other macro developments which are taking place, which could be the source of future risk. For example, what's happening in China, for example, what is also happening to the future level of debt in different societies, and so on. So the focus is shifting from past to the future about, what kind of risk can we possibly expect? How different are these risks likely to be? So that's the first principle. The second one is that the next crisis will be caused again by systemic forces. It would not really be your usual recession crisis whereby there's a recession in one country and this would really spark the crisis. There are too many factors at play here. So it will be broad macro factors which could be the source of risk. In which case, there is no point in creating firewalls around your individual investment positions. The best thing to do is to protect the whole portfolio rather than individual positions. So those are the two guiding principles. Against those two principles, there are a number of approaches which are being used to manage risk. One of them is much broader asset class management. The emphasis here is on managing liquid assets as well as illiquid assets, developed markets as well as developing markets, mainstream investing as well as alternative investing, and so on. So the palette of assets which are now being used in a typical portfolio is much broader than was the case in the past. At the same time, the positions in each of those asset classes are much smaller. And the smaller positions are there simply because it's easy to move in and move out when you've got small positions rather than when you've got big positions, because the prices can move very adversely against you if you've got large positions in the event of a big meltdown. So broad asset class diversification is a major factor there. The second one is duration management, because pension plans have loaded up on fixed income, and duration risk is very, very prevalent in the portfolios. So now the emphasis is really on going after fixed income of shorter duration, such that when the portfolio comes up for maturity, and if interest rates had gone up, you can get out of one asset, fixed income asset, and go into the other one and enjoy a higher rate of interest. So that's the second factor. And the third one is the whole risk-based approach to diversification. In the past, diversification was based largely on the choice of simple asset classes like equities, bonds, alternatives, and so on, only to discover that many of these asset classes were exposed to the same kind of risks. For example, if we look at US equities are highly correlated with US high yield. One is equity asset class, the other one is bond asset class. And yet, they share common risk characteristics. So the idea is really to identify different risk factors, identify the assets which really go with those risk factors, and then invest in assets in a way which help to minimize those risks. So risk factor investing, to me, is perhaps the most exciting development since the crisis. So we've got those two general principles, and then we've got three main mechanisms of managing risks.
Which of these in this chart are they having the most difficulty with? Did you get a sense of that during your discussions?
Yeah, the risk factor approach, which is the most promising one, as always, is posing the greatest difficulty. For example, one of the risk factors is future levels of interest rate or future levels of inflation. Now, it's one thing sort of saying we're going to try and anticipate what these levels are going to be, and quite another actually coming up with the right number. We have been expecting interest rate increase in the US since about 2013. And there has been one interest rate increase, and now there is a feeling that even that was a mistake. Now, so when you got your risk factor approach, you got to make correct predictions about some of these risk factors in future. And predicting the future in today's environment is more difficult and more prone to error than it's ever been.
Well, I think a big part of it is the central bankers themselves seem quite confused, and I'm thinking of Janet Yellen's recent FOMC meeting when instead of 4 increases, well, maybe it'll be 2 and even slower than we thought, and maybe. And as we may see a recession in the United States come out of nowhere, to her at least, as the slowing global economy washes ashore here. So it's a very, very difficult proposition. Shifting to the next area in here was structural solutions.
Yeah. Now, the idea is, when you've got deficits of the sort that pension plans have now, and let's emphasize the fact that not only have they got deficits, but they've gone into a negative cash flow situation because of aging demographics. There are something like 30 to 40% of pension plans around the world are in a negative cash flow territory, which in plain English means that they're burning their capital every year in order to be able to pay their pensions. And, if I can just put a more funny spin on it, these pension plans are now turning into Ponzi schemes, because what they're doing is looking after the current generation of retirees and, not leaving enough for the next generation of retirees. So we have a situation where plan deficits are bad, cash flow situation is terrible, and that means that there are only two kinds of approaches that one can adopt. One of them is the investment approach, which we talked about last time, which is what asset classes can you use to improve your asset values, which in turn can improve the funding ratio. So that's the investment approach. There is also what I call the non-investment approach, whereby you tinker with the plan structures, like, for example, you can raise retirement age. You can raise the contributions made by employers, for example. You can reduce the level of benefits, and so on. And what we found in our report is that all those changes are now being implemented. The biggest one is, of course, changing the retirement age, because by increasing the retirement age, you can reduce your liability. For every 1 year increase in retirement age, you can reduce the liability anywhere between 3 to 5%. And that really does fit directly into the funding deficits. So raising retirement age is really becoming a very popular measure. Having said that, it's not popular amongst plan members because many of them signed up to a pension plan, which basically sort of said, as a man, you can retire at the age of 65. As a woman, you can retire at the age of 60. And now we're basically saying, hey, folks, that's not on. We really got to change this. In countries like Netherlands, retirement age is completely flexible, and it's linked to life expectancy. As the life expectancy goes up, the retirement age goes up automatically by law. So I have a feeling that more and more countries are going to do that. So that's one particular approach which is being tried out. Having said that, Gordon, it's not very easy to make changes to retirement benefits because these are hardwired in people's job contracts. And to change those benefits basically means you've got to put some money on the table. You've got to buy those benefits out. And plans don't really have the money to buy their members off. And this is particularly the case with public sector plans in the US, where for years and years they've been kicking the can down the road and really avoiding this situation about how they're going to meet the future liabilities and so on. Successive governments have tried to change the benefits, but, it's very difficult when these are, as I said, hardwired in people's job contracts. So whereas this is the right way to go, it's not an avenue which we can travel too far down, simply because of legal obstacles.
In the United States, the governments and agencies, and I'm talking about at the local, state, and federal level, still have defined benefits, and they're underfunded. But the corporations, you're hard pressed to find any corporation that is not already a contributory benefits, and that is such a big gap. And they themselves are even underfunded. Is that the same situation in Europe? And
Yes.
And what about the underfunding levels? Or is that steadily increasing as they're unable to make those changes?
That's right. The UK and the US situation is very similar. For example, last time I looked at the number in the private sector, for example, the average deficit in the US was average funding level was about 80%, which means 20% deficit. Yes. In UK, it was about 78%, 22% deficit. The differences are not really that big. And more and more employers are basically, first of all, changing the membership requirements. In the past, every new employee automatically was enrolled in the defined benefit plan. Now, the plans are closed to new members. The second thing that they're doing, which is even more daring, which is to freeze the future accruals for the existing members. In other words, the benefits I will get in future will be frozen at today's level, not at the level when I retire. And that basically sort of means that the benefits that people are going to get are going to be much lower. The third thing that they're doing is moving away from the final year salary formula, whereby an individual's pension entitlement was based on their last year of salary. Now we're looking at career average salary. The Dutch are looking at career average salaries. The Scandinavians are doing the same thing. And all this really has an effect on future liabilities. But having said that, these things are necessary but not sufficient. The extent of the crisis is huge. It's such that I was recently interviewed by Financial Times, and my view was that, particularly in the case of public sector plans in the US, they'll have to rely on Uncle Sam to write a big check. Washington will have to step in sooner or later because the level of deficits are such that there's no likelihood that individual retirees will get the benefits that they have been promised in public sector in the United States.
It's pretty simple arithmetic. We in the United States have 75 million baby boomers retiring, about to retire at 10,000 a day. And I think the best numbers I've seen is the unfunded liabilities, which include Social Security and Medicare, the medical part of it, are upwards of $84 trillion versus the 19 trillion that's part of the budget. So it's unfundable. There is definitely a crisis of some degree coming, whether it's not just financial, but also having to adjust those expectations. And it's pretty tough to do it when you're at retirement age, and that's the only income you have.
Very difficult. That pension promise was easy to make, but it's proved very hard to keep. And retirees also happen to be the most vocal of the political groups. These folks vote at the general elections, at local elections, in far greater numbers than any other age groups in our societies. So, there is great power there. And their great power has been used to protect the positions of retirees. In UK, for example, the current government has improved retirement benefits for retirees every year for the last 15 years or so, because this particular group is politically very powerful. And, we're now into a situation where benefits are handed out on the basis of how much power every particular vested interest has.
I think it's starting to show itself in our primaries in the United States, not about pensions, but the frustrations and the inability to maintain a lifestyle if you're working or nearing retirement, or in fact in retirement. One of the things I've observed, and I'd like you to contrast it to Europe in your study, in the United States we've always maintained that the retirement was a three-legged stool. One element would be the U.S. Social Security program, which in itself has some major issues we're talking about here. Second was the corporate or the company pension, where your employment came from. They've went away. They don't exist anymore. They're contributory. And the average 401k or self-contributing is about $18,500, which would probably get you half a year of retirement at best at the current levels. And the third was the money you save for your retirement, your nest egg. And every pensioner say it's scaring them because they're not making any money on that retirement. So they've had all three legs, or at least two of them pulled out already, and the third one they think is not going to be there. They're terrified. Is that any different in Europe?
No, it's exactly the same, Gordon, except that here what we have found is there has been enormous growth in defined contribution plans. Most of the new money in the pension space is going into defined contribution space, simply because the DB plans are closed and more members are enjoined to join the DC plans. Having said that, we are, as a result, personalizing the risk. In other words, what we're doing is we're transferring risk from people who couldn't manage it, i.e. governments and employers, to individuals who don't even understand it.
I think that's a really important point, who don't even understand how to do it, the risks they're taking, any kind of approach. This is not their forte. And they're at the wrong stage of their life to try and assume those roles.
Yeah. In UK, 50% of citizens can't tell you what 50% means. Okay? And we expect these folks to become financial planners, and we expect them to run their financial affairs in a way which would maximize their interests. The whole thing is highly irresponsible. This whole idea of personalization of risk is highly irresponsible. We did a study last year.
Who's driving this thinking? Is this is being driven politically? The corporations trying to get out from under it? What's the catalyst for this thinking?
The catalyst is really this.
Other than lack of money, but I mean, who's pushing this?
There's no money in the kitty, as we say here.
So any owners of a pension are the ones pushing it.
That's right. Now, we got some pension plans here in the UK. For example, British Airways. For example, British Aerospace. These are amongst top 100 companies. Their deficits, and I mean deficits, not liabilities, deficits are bigger than their market capitalization. Okay? These companies are technically insolvent because they have liabilities which far exceed the capital value of the businesses. And we have a situation where, they're making fresh cash injections every year in order to please the regulators. But no sooner they do it, something else happens. There's something else in the last 2 years has been falling interest rates. And with declining interest rates, we have a situation where, liabilities are rising because you're using a low discount rate. And discount rates have now really, got as far down as zero. Now, when you divide something by zero, you are really talking about a number which cannot be calculated by any computers. So we're in a situation where, this whole pension system is not reliable or stable. I refer to them as something which has got a stability of an inverted pyramid now. And
maybe a pyramid is the right description too also.
It's untenable. It's a sad thing to say. I'm talking about my own future. I know that my pension plan is not really going to meet my needs. Now, if we go back to DC plans, in the US, as you know, they started back in the early 80s, late 70s, early 80s. So a system which has been going for the best part of 40 years now. It has plan balances of around $60,000, average plan balances, or it's got average plan balances of something like $200,000 for folks who are close to retirement. With $200,000, what kind of annuity can you possibly buy? The reason why these plan balances are so low, there are many reasons. One of them has been low contribution rate. In the US, it's been very low compared to other countries. But the other reason has been individuals have been left to make their own asset allocation choices. And when you do that, what you find is that they always ended up buying five-star funds. They buy high, and when the funds tank, they sell them. And, that's really been the story. So they buy high and sell low. And it's exactly the opposite of what they should really be doing. So you find a situation where, more and more money is not really delivering returns of the sort which are expected. And that's simply because of very suboptimal asset allocation choices. So we have a situation where, defined contribution schemes, on the one hand, are regarded as a panacea because that means the governments and the employers and other agencies in the nation would say, well, we've done our bit. Now it's up to you, Mr. Citizen or Miss Citizen. But individuals are singularly ill-equipped to run their retirement portfolios. I've got 4 degrees, and I read 4 newspapers a day, including Wall Street Journal and Financial Times, and I can't run my own portfolio. Because running investment, it really requires very specialist skills. And to get individuals to do it is really an act of highest folly, in my view.
And those who are doing it, and I associate with this group every day, are pulling their hair out and scratching their head because they feel like they're operating in a casino with no rules, with high expectations of what they must deliver. And so the risk that they're having to take borders on not investing, not speculating, outright gambling. And these are the professional money managers. That business in itself has changed. A separate question for you, is the taxation on your pensions. I have had many people come to me in the United States because they're retiring, they're getting the U.S. Social Security, and then they're suddenly stunned to find out, because they can't live on the Social Security, they have to have other work because they're not getting the income from their investments. But once they start to work and they make relatively low threshold of other income, so total income, at $35,000 and $44,000 a year, they have to their Social Security is taxed at a higher rate or percentage. So effectively, the more they're starting to make, the more of their Social Security they're returning to the government, and it's just catching them off guard because somehow it changed while they weren't looking. Is that happening in Europe? Are they changing the taxation of these earnings?
Well, we've always had high taxation in Europe. When it came to Social Security benefits. So if I was a retiree, whatever income that I get from my retirement plan, whatever income that I get from various government sources, various Social Security programs, all that is lumped together. And then, a progressive rate of tax is applied. And that rate of tax could be really quite crippling. But fortunately in the UK, even those who've got defined benefit plans, their average entitlement is about 12,500 UK pounds, roughly 20,000 US dollars. On top of that, they would get something like 10,000 from Social Security. So their retirement income would be somewhere in the region of about $40,000. That would keep them in a basic rate of tax. That wouldn't push them in a higher rate of tax. But once they go past 40,000, then they move into a higher rate of tax. So guess what they do in Australia? When folks retire, all the money that they have in their retirement pot, they empty it. They buy a property, they give money away to their children, they go around the world, they buy a yacht, and so on, with every expectation of relying on Social Security safety net by the time they're in their 70s, early 70s. And in Australia now they're thinking about bringing in compulsory annuitization. There's a lot of opposition to that. But sooner or later, they'll have to do that because, again, Australia, like US, like UK, and like other defined benefit markets, they have got severe budgetary problems. So the problem that we're talking about here, Gordon, which is personalization of risk, it is not anybody's first choice. It is not anybody's last choice. It's everybody's only choice. We're in a situation where employers say we haven't got money to put in the kitty. We've got governments which are saying, we've got unpalatable level of deficits here. And so individuals are now really being asked to shoulder more and more responsibilities for their retirement planning. It's not easy for most retirees because, as I said earlier on, they do not have the degree of financial literacy which can help them make right choices and right decisions. Advice is very expensive as well. Most people's plan balances are less than £100,000 in the UK. Well, if they're less than £100,000, financial advisors would not be interested in them because financial advisors end up charging something like 1% of the assets and so on. Now, you can't part with 1% in a period when the rates are so low, when markets are so volatile, and so on. So we're in a situation where, we're really caught in a vicious downward spiral. There are so many forces at play here, and each of them is reinforcing the other one, rather than, trying to act as a countervailing force. So it's really looking quite grim at the moment.
I mean, we have at the Financial Repression Authority an interesting perspective on the change or a view of it. And I say that we offer retirement living facilities in Southeast Asia, specifically in Thailand, in Malaysia, and in Indonesia. And these are very, very high quality facilities. And the reason I raise it is the interest we're seeing from various countries, and I must say the UK is a primary leader, of people living who cannot get by, have on their pensions, and are being, I would use the word, forced to consider these homes in these areas, and they're of the finest quality, and they're substantially less. Well, they're affordable. They can actually live a very high quality of life. And it's not that they want to do this, because it's such a shift in culture. But there's such a big group of expats living in these countries now and growing at such a rate that they feel like they're going home. And in the case of Britain, a lot of these areas were British colonies or facilities, and so they drive on the wrong side of the road, if I can say that, over there too. But we see it, and it's growing at a substantial level. It's like people fleeing with no choice. As I just throw that as a caveat. And when we got into doing this opportunistic, I think we completely underestimated, and it's only going to get worse. We believe.
That phenomenon is very prevalent in Europe here, except that instead of going to far-flung jurisdictions like Thailand or India, people tend to go to low-cost locations like Portugal, Greece, and Spain, where money goes quite far. In a place like Greece, for example, or in Spain, for example, the cost of living is about half of what it is here in the UK. So you have people from all social strata, moving abroad, and the other attraction is, of course, the weather. Spain and Portugal, they are very agreeable places to live in compared to damp and wet London or rest of UK. But I'm not very familiar with examples of folks who have really ventured much further out. I travel in Asia quite a lot, and I come across a lot of British expatriates. Not really quite sure about what their circumstances are. I suspect they fall into the category that you've just described.
And they are and growing at quite a rate. But maybe this is going to be an unintended consequence of this crisis, of a lot of people retiring in areas that they have no choice or didn't think of before. Technology is changing that allows them through Skype and media to stay close to their families. Most families themselves are spread out anyway because of where they graduate and jobs, so they get home for vacations, and so the staying close to home has changed in the world, and the world being so close. So I think there's going to be a lot of surprising reactions and changes as this
Yeah.
unfold, and we're seeing the tip of the iceberg. Any other areas in terms of personalization that you could comment on? I have the chart up that you'd put together in your report on that.
Yeah. Employers are, as I said, they are forced to go down that route as the only choice that they have. They know fully well that they're transferring risk to somebody who doesn't really understand risk, but they're basically sort of saying we either do that or we go bust. And the legislative climate favors the employer approach. For example, in UK, what we've done is brought about what we call a lot of pension freedoms that were introduced last year. Pension freedoms basically mean you don't really have to buy annuities. Not that many people bought annuities, but you don't have to buy annuities anymore. You can take out large lump sum free of tax purposes, and you can invest in a drawdown portfolio. And on paper, these freedoms make a lot of sense. The difficulty, however, is really that people who end up with these large pots of money, they don't really know what to do with them. And they're very much at the mercy of who they speak to or what they read in the papers. And the scope for making wrong asset allocation choices is very real indeed. So this idea of personalization of risk can be very much justified on libertarian grounds. I don't doubt that at all. But on pure economic grounds or financial grounds, they could be a road to ruin for many families. Going back to the other point that you had made about folks moving abroad, what we also have is a situation where, yes, our folks are living longer, but they're not necessarily leading a very healthy life, particularly having lived a long life. The final ending is usually through cancer or some other dreadful illnesses. And it's at that stage that people think, so who is going to look after me if I'm living in Thailand? Or will I have enough money to pay for medical expenses if I ended up in an institution in Thailand? Or will my family be able to visit me, and so on? So, for every solution that you can think of, where people can move abroad in order to make the ends meet, there are also some disadvantages associated with that, which sort of come in the form of some of these difficulties further down the line when a family finds its head suffering from serious illness, for example. Life expectancy is going up, but the disability-free life expectancy is not really going up. So that, again, really argues for having decent retirement pots, money that can last for a long period, money that can last, not only outlast people's lives, but also have enough in the pot in the event that somebody needs to have prolonged health care.
And when you say money lasts, you may have it, but what does it buy in real terms? And so you have the problems of the debasement of the currency or a reduction of purchasing power, ever mind the actual earnings and income at nominal rates you get. And we're having this discussion in a time when the financial markets have never performed better, at least the elevated levels they're at. Stocks, bonds have been at very, very good levels relative to history. Matter of fact, it reminds me of the 2000 peak and the 2008 peak. My point here isn't doom and gloom, but markets do go in cycles, and drawdowns are part of it. And we've talked about how the pension plans are trying to protect that, but it's normal process that we should expect some fairly serious down cycles in the financial markets. And I don't see any capabilities to withstand that.
No. What is really worrying in the current environment, as far as I'm concerned, is the fact that asset values have been artificially inflated.
Yes. I didn't want to be, I wanted to be polite.
Yeah. We've got a lot of conviction-less trades here. People have been forced to do things that they would not normally choose to do. This is individuals. This also applies to pension plans. This applies to sovereign wealth funds, this applies to insurance companies and so on. Everybody's been forced involuntarily up the risk curve. And that basically means that, everybody's got the trigger on the invisible sell sign. That, if we have a big drawdown, if we have a big rumbling in the market, then it's likely to be amplified. And the contagion effect will be really quite big because there is a strong conviction behind the current rally. Now if rates remain low, if as a result economic growth improves, if that boosts earnings, then we can begin to say markets look realistic. And if there is a correction, we may get correction of 10% or something, which is livable with, which we can cope with. The worrying bit is really that unless we see growth in earnings, equity prices are going to be very difficult to sustain in the event of a big drawdown. And we saw a glimpse of that back in January, that, when the carnage started, it was just unbelievable. What we saw in January was not something that many people were expecting. I have to say that I wasn't at all surprised myself, having listened to various investors about, lack of conviction about the current valuations and so on. But we're in a situation where the markets have been artificially inflated, and people are really quite worried about it. And this is what really makes future planning extremely difficult, because do you take current returns, or do you take current equity risk premium as a measure of what is likely to accrue in future so that you can make your retirement plans? It's very, very difficult. I know a lot of people who are putting off their retirement simply because they really don't know how the markets are going to pan out. And as a result, you interestingly refer to this three-legged stool. One was the government, the other one was the employer, and the third one was the individual. There is a fourth leg of the stool which is emerging now, which is working part-time in retirement. People are forced to go on working. Now, some people choose to work in retirement. They've had very interesting jobs. I can't imagine myself ever retiring. I've had such an interesting job. But there are other people who wanted to do other things in their retirement, and they're not able to do that currently, simply because they know that their money isn't going to last long.
Yeah, the growth in the labor force is actually people over 55 that are finding the job, staying in the working, even though they may be on some sort of pension, because their costs force them to do that. And that is definitely a growing sector, which is taking away jobs from the youth.
Of course.
And because there's only there's a shrinking pool of really the number of jobs, so it compounds itself obviously here. So
Yeah.
we it's going to be a difficult time. People will be creative. We'll come up with other solutions. Is there a key message that you'd like to leave with our listeners here, Amin?
It's a rather gloomy message, if I have to be candid with you. And my message is, that question everything. Because we are in an environment where the old certitudes are dead, or at best they have been sidelined. And therefore, approach everything with an open mind, and don't really believe that things are going to get dramatically better. Don't believe that they're going to get dramatically worse either. Try and arm yourself with as many possible options as possible. One of them is to save more, the other one is to spend less, the other one is to work longer, and so on. And I think it really sort of pays to be more prudent than ever, because we live in an environment where nothing can be taken for granted.
Yeah, you mentioned this word "save more." That's a whole new concept, at least it borders on being outlawed here, as everything as we go to a cashless society of negative interest rates. You're being forced to spend it or lose it.
I came across a statistic the other day which said that 80% of Americans spend 120% of their income every year.
That low? I think they're lowballing that. And it would seem, and it's just the fact of life, unfortunately, and it becomes ingrained part of the culture.
Yeah.
And for decades, we always wondered when the American consumer would stop consuming, because no matter what, it just kept on going. And now we're a 70% consumption economy, and we've gutted our middle class, and it's not there. The income is not there. And I would argue the United States has been the global engine of growth.
Yep.
That's consumption. That even powered the growth in China, and that expanded. And now what we have, I would argue, is we brought demand forward, but we have got excess supply. Cheap money has fostered more supply, lost pricing power, and I think we might have killed the golden goose. So it's not a pretty picture on many fronts, is it?
No.
Here. but one of the things I have a lot of faith in is mankind and a human spirit, and we always, no matter how bad, we always seem to adjust. And maybe these are signaling that clear structural changes are needed. This is change trying to happen. And for those who prepare and really listen and read the kinds of things your report does an outstanding job. It's really important for a lot of our retirees and people planning to really read this to get a real sense of what's going on, because you surveyed the professionals in the field honestly and what they're doing, and I think it's must reading. Amin, thank you. I always enjoy our conversations, and we'll have to have you back. The goal here was risk mitigation, and I think if everybody was listening, you can see where the risk can be mitigated to the best degree that can be today.
Yeah. Okay, good. Thank you very much for involving me, and look forward to hearing from you again.
And Min, could you tell our listeners how they could find out more about your work? Because you do a lot of reports and at Create Research.
Yeah. Over the last 25 years, we've done lots of surveys, and we've also published a lot of white papers. These are all highly readable. I've had a training as a journalist, so I try and write in very plain English. And all our reports and papers can be found on our website. And the address is www.create-research.co.uk.
Amin, thank you very much.
Thank you. All the best. Bye-bye.